Hey guys, happy October 3rd. And wow, beginning of month. What a weird day because man, this market rally, I trust this about it as much as I trust. These indices up 2% makes no sense, especially the Russell. I don't know why the Russell has any business trying to be up 2% because it's not like anything's, like you got your top two assets in the Russell, AMC and this other kind of healthcare company down, and then everything else along. You guys, seriously, I think this is just you should take opportunities to buy puts today. It's really, I'm thinking about it. I may be proven wrong on this, but here's what the market looks like. Tesla came out and told us what was going on, that they were seeing. And I got to tell you, if there's any confusion that what Tesla had to say was very bad for Europe, and the fact that I will always and continuously probably have short exposure to Europe until they finally own up to what's going on over there, it can't be the case that an electric car is more expensive to run than a gas car. It just can't. And then to have Europe rally, that just is ridiculous. It's the most ridiculous thing I've ever seen, such that you almost think that what's going on here is just trying to help, like it's being engineered in some way, or it's just a short-term breather. We do have Yom Kippur, so perhaps some people are just asking for forgiveness or giving some people a little break to get out. But man, what an ugly market that I anticipate we are setting up for. So really just take the opportunity to hedge where you can. And I think we're going to have to talk a lot about that because earnings season doesn't start for 3 weeks, and then everybody's going to have to come clean on what's going on. I think more than anything, I was really surprised at how aggressive the rally is, which is part of the reason why I think it's engineered in a lot of ways, because you did have this memo from Credit Suisse's CEO trying to reassure investors that there's nothing wrong with the bank, as the CDS, the credit default swaps, continue to widen, suggesting the default is imminent. And I think the reason, there's a little bit of a backstory that you just kind of have to understand to that. I'll give that in just a little bit. Let me go through my usual other stuff though. Oh, past performance, not indicative of future returns. This week, there's not really anything that's going to be hyper relevant. We really are in this dead period for economic data. So any one of these things could just magically be the thing that people decide is going to be what thematically sets trading off the week. We do have, however, quite a lot of meaningful consumer staples companies reporting Wednesday and Thursday. So we've got Lamb Weston. They're all about potatoes. And quite frankly, you can draw a line from Lamb Weston to fast food restaurants, and that's really about it. But Lamb Weston also has been in turnaround mode for like 2 years. So there is that. Conagra I'm watching just because I need to understand what's going on in the grain complex and how exactly that's going to feed into the consumer. Constellation Brands, ticker STZ, is going to be alcoholic beverages. I care because I'm just interested at what mix people are spending their money on, but I have no positions in any of these. And then McCormick West will tell you what's going on in spices. But oftentimes McCormick West also tells you what's happening with the rest of agriculture, because the spice market, oddly enough, has elements that transcend, so to speak, strangely enough, but it is its own animal, fair and square. Okay, we're going to talk Credit Suisse, but I need to kind of give you a little bit of feedback on this. Credit Suisse, I do not cover the European banks for a reason, okay? You don't cover the European banks because they have a different set of regulation, and because I'm not in Europe, so I can't see it, and also because the European banks don't report earnings the same way that American banks do, okay? Even if we have global multinational banks, investment banks, whatever, they just don't report the same. They don't offer the same amount of disclosure. The format is not the same. It's really kind of crazy how different you would think. Globally, they're all big. They're all doing approximately the same thing. And yet, no, very, very different. So I will give that caveat. That said, let's not pretend. May has a pretty big background in risk. So when I look at this, there's a couple of things that you kind of have to note. And one of the biggest things to note about Credit Suisse is where they really started to get clobbered, aside from all the other reasons they get clobbered, was Archaegos. So it's really on the prime brokerage side. Couple other things that you have to know, particularly about Swiss banks, is that Swiss, there are just a couple of areas where you would custody your money. And that is Switzerland, Ireland, and Luxembourg. And it has to do with tax stuff if you're going to do investment across of Europe. So watching anything get disrupted in Europe, you do have to be very cognizant of the geography, and particularly on banking, you care, because if something crazy happens, it will also impact the pension funds. And so today I've decided to actually break my thing and actually get out of my lane, which is not my, Europe. I usually don't comment. I try really hard not to stay in my lane. I know there are better people in various areas to talk on this, but Richard, who does our amazing morning show on the trading side, said, nonetheless, I care what you have to say on this. So I'm going to go ahead and tell you layman's terms. If I was looking at Credit Suisse and trying to say some things or discuss, what do I see? And I see a terrible unwind is what I see. It looks like they're unwinding the bank. To me, is what it looks like, calmly and quietly. How they're exactly going to do it has been a mystery to me since the first day it came out, because quite frankly, this PB blow up was not insignificant. And also him coming out with a discussion on it, really, to me, is very similar to what we saw with both Lehman, Bear, and Merrill back in the day. And ultimately, what's going to have to happen, I think they have to wind down the size of it first, and he's going to start to sell off parts of it. And we're just going to see that. And it's just whether or not the markets are going to work in an orderly fashion to help him out. And we've got a couple little dynamics, but I do want to show you the actual numbers so you can appreciate where I'm coming from and why I'm a little sensitive to saying what I'm saying. But we're going to go through it. Here is Credit Suisse as of the July quarter. So that was July 28th that they reported. And you can see that their provision for credit losses here was about 4 billion on the investment bank. And here, point one on how they really differ from the US banks is that lodged within this investment bank is all of the investment banking activity. Wealth management is really just their high net worth, and then it's their what they're calling private banking, but is their high net worth asset management business. This would not this and this would go together in a U.S. bank, asset management and wealth management. So the prime brokerage is sitting in this part of the business. They provisioned a lot, 4 billion, and they released 100 million this last quarter, thinking, okay, I think we finally unwound enough of this. Okay. And you can see the massive decrease in size across all their businesses. That represents to me business that is leaving Credit Suisse and going to other safer places. Okay. So essentially, though, given that the prime brokerage business also oftentimes holds the assets of a pension fund that is not based in Switzerland, but might be based in the rest of Europe, if you're a pension fund, you probably are slowly unwinding what you have with Credit Suisse to move it to another bank. And if this is confusing that they would be able to maintain this business given what's happened, let me just disavow you of that confusion, because anyone that has any meaningful gray hair, right, self-included, that lived through Lehman knows that if you have a concern with a prime broker, even if they're not going to have any major problems, you need to move out of that prime broker, because the last thing you want is to have to deal with that. It is really painful if your prime broker has a major event for you to figure out where your assets are custodied. And that is really 100%, because these assets that you think are liquid and can cross easily will not cross the way you think they do in the event of in like kind of a catastrophic type event. Okay. So like 100%, you can see how much the revenues have declined, which on a piece that contains the and is right here in investment banking, right? Okay. Along with that, in the breakout, which I will show you in a second, is a decline in fixed income and equity trading. That is what we saw across all the investment banks. So I don't see that as being too weird. I would say one of the pieces that they talked about extensively, which I will go through in a bit, is the securitization business. Securitization business represents a couple of different businesses on the fixed income side. It could be as simple as the mortgage business, which is what they talked to and where they originally bought that business, grew it into this very beautiful business, quite frankly. But it also includes the very funky structures that you might have within structured products. So they were trying to get additional funding just for that business, which is its own curiosity in its own way. And I'll tell you, like, without getting too into the weeds about it, in general, structured products already has a number of different ways that it can be moved off balance sheet. something, so yeah, the fact that that was such a huge component of the July call bothers me a lot. But again, I don't know Europe as well as I know the US, but I'm pretty sure I'm right on this. Let me just say it that way. Okay, assets under management, we watch that closely as well to get the health of any investment bank, period. And you can see that as you'd anticipate, we do see a decline in assets under management. Here we're looking at this column. Should have put this in red to make it easier, but this is your quarter over quarter and year over year decline. Just so you know, I went ahead and started looking at some of the other investment banks, but I haven't had a chance to really do too much yet with all the other investment banks yet. But you can see that there's a decline sequentially across every single one of the areas, both traditional and alternative investments. Alternative investments take a little bit longer to unwind. Richard, I'm going to come back to you after I finish this off a little bit, because that way we can kind of get through some of this. So I'll come and take questions at the very end. But overall, I think this number is a little bit, well, they're losing assets, okay? But it's not, but this is just going to be off the wealth management business. This is your high net worth folks. They're losing a little bit more than the classic asset management business, which does house, by the way, a couple of the fund to fund distribution arms that they have huge equity stakes in. So that is also not great, but this isn't like people running for the exits, but it's not great. Now, some of this is off of foreign currency, but it's not enough for it to be mostly or even purely explained. And if anything, for most of the European banks, FX was a net neutral to slightly helping them. I'm just going to say it, even though in fairness, if you look at the balance sheet, you could see where it's a negative and where it's a positive. But because the US markets have been so strong, and because they do have some folks in Europe that are investing in US related assets, both fixed income and US overall, I would say that if you really look at the type of debt that they were looking into, they benefited from the fact that we have the largest debt markets, period. We issue more mortgages, we offer more yield, so on and so forth. So this is bad, worse than the other European banks, but more or less in line with what we saw in the US as far as as far as changes and shifts in assets under management. Now, this was also hit a bunch because, and it has to be, and the reason it is this is what banks take in reserves, is the Cet Capital Ratios, okay? And these really are not bad, not great. And I think where people really got aggressive with them was the Cet Capital 1 ratio of the parent bank going, it's at 13.5% now. The tier 1 leverage ratio, actually, these aren't bad numbers, except that 13.5, we would anticipate them to be increasing that. And it was a minor baby decrease, smallest decrease. That said, what we, how does it relate to like, what does Morgan Stanley, Goldman Sachs hold? Goldman Sachs and Morgan Stanley have actually been well, this last quarter was a little bit mixed, but Morgan Stanley's been holding closer to like 14-15%. Goldman's about the same. They've been holding a lot in excess capital for CET. And it's been a little bit quixotical to me, because really the number can be as low as 8 before there's a real issue, 8 to 10. No one brings it that close unless you're a regional bank in the United States. But this is high. I give them full props for that. But is it high enough if they're having a real problem? Not really sure, to be fair. And finally, the last little piece, or the other little pieces that I would mention, this is the fixed income and equity sales trading business. Equity sales and trading, they are losing. I think these numbers are in line with what we saw in the US as far as down volumes go, but probably here represent the fact that they're losing business on the prime brokerage side. Okay. And then the final thing that I would just mention, I'll just show you Barclays, right? So there are some investment banks that are eating Credit Suisse's lunch. I don't have UBS because I just didn't have time to get through some of their numbers, and I'll probably listen to UBS to see what's up, because they would be the Swiss bank that would have to try to help out to stabilize things in Switzerland. But Barclays doing great. They had NIM growth, net income growth all the way across. Same thing with Deutsche. Deutsche's doing just fine, which is impressive to me because I'm always negative about this company in general, if I had to look from far away relative to the US investment banks. But quite frankly, he's been doing a great job over there. So I can only imagine that he's also, and you can kind of see the uptick in PB business, no, sorry, that's the private banking business, but you can see kind of the uptick across all of their businesses, probably stealing share from Credit Suisse. The last thing I would mention is if you wanted to just keep it on the radar screen and you wanted to just do what I call a Game of Thrones play, which is winter is coming, Europe's going to have to come clean on what's going on there, then you could actually just do a very cheap a calendar spread, which means you would go long the $3, long the $3 Jan 2023s and short the $3 Octobers. You got 18 days left on this. You basically create this at 20 to 25 cents, depending on what time of the day you're putting the trade on. And that way, I don't think it's going to go broke. I mean, you still have quite a lot of market cap. So this thing absolutely can trade down from $3. Let's not pretend. Okay. But is it going to do so in the next 18 days? I don't know the answer to that, but this trade should have the back coming up faster than the front, which is going to primarily, it'll have Vega in it if it starts to kiss $3 again. But this is one way you can keep it on the radar screen for 25 cents or $25. And on the off chance that you have a major issue happening in Europe, this will at least pay you all the way to zero. So you'll get 300. So it'll pay, what do you call it? 10.5 to 1, because it'll go to $3 when it goes to zero. So that's what I have prepared for that. Let me stop sharing because I know Richard was dying to ask questions. How you doing, Richard? Thanks for stopping by.
Yeah, thanks. Yeah, I'm good. I mean, I was out of the market at 10:15 this morning. It was a great start. So just here's my question, right? So we have a lot of companies that are operating internationally.
Yeah.
Some in Europe. And my question really has to do with investor sentiment, or how will companies think about those firms, Tesla, Apple, others, who are operating in Europe, if in fact there is this default by Credit Suisse and other European banks are impacted? I mean, is that going to be a problem for them?
Yes.
Maybe you don't know.
The easiest answer. Look, if Credit Suisse defaults, it's not a small problem.
Right.
And I can't really, that's why I think that all of the banking system has collectively decided they don't want another Lehman. Like when Lehman happened in 2008, there was a lot of cocky stupidity that existed in this marketplace about what it meant mechanically for a major investment bank to default. There was a lot of cocky stupidity. There's really not another way to discuss it. I think Warren Buffett might have been the only person, having had to take over Solly in the 90s, that wasn't feeling that was okay. Do you know what I mean? To be honest. And he was very smart in certain ways not to step in and try to protect Lehman. Look, they don't have a Warren Buffett that has a history of doing that sort of activity in Europe that I'm aware of. Maybe I'm ignorant of Europe, at fair point. So I actually don't know who would step in. So all of the banking system is going to have to step in and make sure they don't have a Lehman. And I can't iterate enough why Credit Suisse is important mechanically in the marketplace. It has to do with the European taxation system and where people tend to put their assets. The only other bank that looks like that is UBS. That's the only other bank that you might want to be able to merge it with in any kind of meaningful fashion. The challenge with doing that kind of merger is, number one, it's going to be really expensive to do it. Number two, that's why I really want to do the work on UBS tomorrow. And if there's anything additional to say, I'll say it. But like you can't, because okay, look, here's the thing. Let's say you're a European pension fund, not in Switzerland. Okay. And also not located in Ireland or Luxembourg. And you would like to invest internationally. You cannot actually custody in very many spots. You're going to have to actually create custody of those assets in one of three places. And I just named the three. You don't just, you can't, you're not going to be allowed to just invest in it from your native country. So you can't let a Swiss bank go under in a very fast, rapid way without allowing people to move their assets to another country or another jurisdiction or another bank. Is a problem. And I think, that's all.
All right. So
the effect to corporates after that is really, the effect to individual companies thereafter, it is a real thing as well. I think it's a knock-on effect because your first and foremost issue will be not just the Swiss banks, but all the banks in Europe, and then also us, quite frankly, because, I'm sure that there are very few remaining US companies, US asset managers that are still custodying anything with Credit Suisse. And if they're
Yeah.
doing so, they're probably very slowly unwinding it and transitioning it as fast as they can, and have been doing so over the first 6 months of this year. But nonetheless, it's not great.
Yeah, and I know you can't predict this, but my thought is just from a sort of psychological perspective, right? If I'm an investor and if I'm invested in the market and you have a major bank failure in Europe, I'm going to be in cash. I mean, I'm going to sell. I'm out.
Well, see, that's the interesting thing. I think if you're a US investor, yeah, you should either be in cash or you should have some solid puts on the portfolio for sure.
Okay, yeah.
If you're a European investor, you got to realize that if you have a Swiss bank failure, cash isn't your safest place. US dollars.
Yes, they're screwed. Yeah.
Yeah. And so
Yeah.
that's why I call it the winter is coming trade, because the other thing, Deutsche Bank, I did get a chance to listen to Deutsche's call. They actually did, in my opinion, for Deutsche Bank in particular, they did fantastic. But the CEO is not a dummy. I was really impressed with him. He has gone to literally every one of the big industrials. As you know, I'm short the EWG, the MSCI German index, because I don't believe them. I don't think they have enough energy to get through the winter. They believe they do. Okay, we have a difference of opinion. That's what makes a market. But he's gone back and he's talked to every single company about how they're going to handle their own balance sheet situation going into the winter. And he swears they all have an ability to do so. But that is a very unique thing to do as a CEO. So I'm not sure how corporate Germany is going to handle it. And the other thing that I'm absolutely seeing through General Mills, okay, in fairness, I haven't seen it across a lot, but I will be listening for it, is the other kind of half of the question that you asked, which is what are US companies doing with their Europe exposure? General Mills is selling it off. Now they spun it, like I said, they spun it like a bunch of champs. They're like, well, those European, we're just kind of moving towards packaged foods that are for folks that are, working from home and don't want to cook really fast. And so it just so happens those businesses aren't what we were, interested in having. But let's just face it, they didn't sell Yoplait US. They only sold Yoplait Europe. And then go on down the line, their Europe exposure has decreased dramatically in this last quarter, which that's a very, very prudent way to say it. Let's say it that way, and very thoughtful way to say it. But nonetheless, I'm not blind. I saw your balance sheet. You know what I'm saying? I saw your income statement. So I do think that there is some of that. Now, Tesla, I had mentioned when I did my review of Tesla, my one concern was the Europe exposure. They do have a lot of China exposure, and then how does Europe get through this? I have no idea. The one thing they could do is sell to Asia. Because the one place that does have a bunch of energy, OPEC's already more or less threatening that they're not going to provide more, if we're going to. So we got this weird situation, which we've talked about, which is why oil would dance below 80 ever. It makes no sense, right? And now OPEC is like, if you're going to play this game where you guys are going to use the futures market to pretend like oil is actually not in shortage, then we're just not going to pump anymore so you can understand what shortage means, right? Like that's really what OPEC is doing. We got one major export, this is it. And you guys are playing this game. We're trying to stay out of it, but you now are affecting our economy, right? So this is a very dangerous game of chicken.
Yeah, it's bad.
Yeah.
Yeah, and the other thing I was thinking, in the middle of the strong dollar.
Yeah.
I mean, I can't imagine that's good for the European banks.
The only thing that's good for the European banks as relates to the strong dollar is the degree to which, so that's what I think is happening in the fixed income piece of the business. Now, like I said, there are people that are much stronger than I am that have been living and breathing European banks for a lot longer than I have. But it really looks like to me that what people might be doing is they're using the fact that we have raised interest rates and we have a strong dollar to effectuate, to basically buy our bonds and then leverage it. And then it looks like a really fantastic return because they're getting both the return from the currency piece as well as from the heightened interest rate piece, right? From the decline in the local currency. I think that's what I understood is happening at Deutsche. It looks like that's what's also happening at Barclays. We'll see, but maybe there's someone smarter than me that can explain it better. The fact is, again, when it comes to yielding instruments, debt yielding instruments, the US market has always been and will always be the largest. And it just has to do with the fact that we have a couple of instruments that don't exist regularly in Europe, right? The 30, we look, financial innovation is a real thing. We created Fannie and Freddie fair and square, and we have had 30-year fixed products for housing for so much longer and with so much. And then on top of the fact that we have a better geography by which to even securitize that as far as diversification of risk, because the whole point of why the United States can do it a little bit better than other countries as relates to creating the 30-year fixed is that you can actually create a risk scenario by putting the mortgages in different locations. We have a lot more geographic diversity. We have a lot more income diversity that we can then play with to create securitization. That's something Europe can't do in the same structural way, period. That's why we will always have a better debt capital markets. That's why it matters that we're good and we're strong, but we kind of need another country to help us out right this minute. I really wish we would resolve things with China, but the geopolitics is so ugly right now that it can't be resolved. But that's a real thing. Again, like I said, I would be intrigued to see what I find out from UBS tomorrow.
Well, thank you for your analysis.
Look, there are people that are better than me. I know there's going to be some people that are annoyed with this that are European specialists. I apologize in advance, but I don't think I'm that far off the mark, to be honest. Anyway, I shouldn't be giggling. It's horrible. I'm sorry. Anyway, any other questions? I mean, today is such a weird day. I don't trust this rally at all, but this market has proved me wrong before, but I don't trust this. Anything else?
No, I agree with you. I don't trust a rally. I think once the gaps are filled to the upside, we're moving back down. So, and I believe, I really agree with what you said earlier about the market manipulation.
Yeah,
these guys,
really
they're
feels
getting the price up. Oh yeah, they're getting the price up so they can sell out of their positions. I mean, and they're trying to close out all those puts. I mean, right now you've got a lot of people on one side of the boat, and they need to make sure that they don't walk away with all the cash. So
yeah, I mean, the storyline for Europe is the same as Game of Thrones. Winter is coming. That's what I have to say. Do you know what I mean?
May normally first day of each quarter you get buying.
You do. That's so true. And that's such a good reminder. You will get a lot of times when the last month was so disastrous, you'll just get people, especially like you're saying, Richard, I think that's what your point was there, is that if you bought puts and you're just closing them out, you're just trying to reset with capital to begin the month. So all that is 100% true. Yeah. So how it starts the month is not how it necessarily ends the month, but oh my goodness. Sorry.
Okay, are you thinking they're going to have a pension problem in Europe?
I think that they have to slowly, you know what? I don't know enough to make a strong statement. This is what I know. I know that especially when it comes, because Switzerland, Luxembourg, and Ireland have a special place systemically within Europe. And the specific place that they have has to do with how you custody assets and how you get to invest outside of your own nation. That has been the case for years, right? That is why if you're trying to raise capital in Europe, you will do it in one of those three countries, because otherwise you will not be able to effectively, tax efficiently raise money in Europe, okay? So I know that if there's an actual default or some kind of banking issue in Europe, you've got, in Switzerland, you got to unwind it gently, gently. We want to talk about soft landing in the US. No, we need a soft landing in Switzerland if the pension funds are going to be okay. I think they end up getting it done.
When a central bank lowers rates for no reason whatsoever other than provide liquidity, I mean, that's pretty scary. It looks to me
It's
like.
it's really weird. Like, I don't even know how to properly digest that news, David. I would be fair with you. And in fairness to anyone trying to digest the news, it is absolutely, as you're mentioning, unprecedented. I don't know. I've said before that because of Brexit, one way or the other, you got to, it's almost like because of Brexit, Europe is like the UK specifically is in a slightly better spot than the rest of Europe. It has a little bit more flexibility as relates to what it can do on the energy front. It can decide to let its continental friends suffer while it saves itself. In fairness, that is a true statement as much as it is a brutal statement. So I'm not excited that I'm saying it. Let me say it that way.
England and Germany both are subsidizing energy. So, I mean,
100%.
that's going to be really expensive.
Yeah, well, England produces enough though, and Europe and Germany does not in any way, shape, or form.
You're the
Anything
best, man.
else? Sorry to be so negative on the first day of the month.
But you're the best.
Oh, I appreciate that. I appreciate, hopefully, knock on wood.
I agree.
Guys, take care. Bye.